almost the same.
Two graphs are almost the same, right?
Yeah, but there is a huge difference in 1980. So if I invested 100 in 1913 in Dow index and 100 in gold in 1913, where would I be then in 980?
That depends on where you take it. When you take it at 1932, the ratio is just about 1 to 1. In 1932, gold is about $40.
I said 1980. 1980.
Right.
1980.
Well, no, I understand. I'm just trying to give you an example for a long term of the prices which I know exactly what they are. 1932, gold is about 40.
Sorry,
Guys, you'll get it after, or we're gonna get it during the break. So, I know the numbers in my head, okay? 1932, gold is just about $30-some, $35, it gets devalued or so, and Dow Jones is about 42 points, okay? So they're just roughly 1 to 1, okay? At 1980, they're just about the same. Gold is about 850, okay? And Dow Jones is roughly about 900 or so, 1,000 or so.
But that's not what your graph says. That's not what your graph says.
Well, okay, this is 1929, that's
I'm talking about 1980, where there is the longest gap between your green line and and the peak.
Right.
Down peak.
Okay, so
this is
Just my question.
Yeah.
right.
You
So
start from 1913, where you have a 1-to-1.
okay. Okay.
And when
It
you
doesn't
look at
matter.
1980, you do not have a 1-to-1. You have
Right.
far from 1-to-1.
Right. So no matter where you start, okay, that's very easy question. No matter where you start, in 1980 you will be ahead in gold up against stocks. So you can start in 1900, in 1920, 1930, 1940, 1950. At any point when you start in 1980, you will be certainly ahead in gold. Yes, absolutely.
I'm not starting in 1980. I'm starting in 1930. My question is, if I started in 1930,
Yes,
let me summarize.
where would I be?
Yeah.
All right.
Let-
Okay,
let-
now
let-
I explained your
1980.
So let me summarize the question. What I understand is, if I had bought 100 units of gold in
Right.
1913, when the
Yes.
third capital era commenced,
Okay.
and if I had bought 100 units of what is equal to the stock market,
Correct. In
where would
19,
in 1913?
you will be twice ahead in gold relative to the stocks. Yes.
So that is the answer.
That is
I
the
think,
answer. In other words, the ratio there was about 4 or 5, and here the ratio is about 1, so we're going to be even 3 times ahead. Yes.
All right.
If you pick the end point 1980, no matter where you start, gold will be always ahead. Now, the opposite is also true. If the end point is 1999, no matter which year you begin, stocks will surely perform better than gold when the cutoff point is 1999.
Okay, so that's what the graph says.
Yes. Okay.
Okay.
I think I very much appreciate this very spirited debate. But also for time's sake,
Yeah.
I think we should move on to the next slide because
Yes.
although
Well, if people want to ask,
yeah, but
what's important-
obviously not that I want to cut you off from questions, but there's quite an extensive
All right.
seminar. And again, there's also an opportunity to ask the professor questions. I'm pretty sure via
Right.
email and also in the breaks.
Yeah.
So
Well, I mean, and
let's move on.
we try to do as many as we can. All right, so here's the thing. If there is a commodity bull market, as there was one in the 1970s, or as there was one that started in 2000 up until 2010, and as we expect to be now on a second leg of a commodity bull market, what does better, what does worse? In other words, what is the performance of different things? In a commodity bull market, we have an easy answers. Stocks are the worst. Second worst are bonds. So in a commodity bull market, you don't want to be in stocks and bonds. Well, what do you want to be? Well, gold, silver, and of course, oil in that particular case. And you can see some other things that are in there. In other words, in the commodity bull markets, gold and silver are the typical top or best performers, and stocks and bonds are the worst performers. And this is why it explains in the longer run, it depends where you start from and what is the cycle. If it's a commodity cycle, stocks and bonds, bad, okay? Commodities and gold, good. In the opposite, things change. They get a mirror image. In a commodity bear market, the whole picture is the same, but upside down. Stocks and bonds perform great, and gold and silver perform relatively poorly. The picture is a mirror image. Let's see what else we got here. All right, fundamental analysis. I'm going to take, because I got 5 analysis. I want to maybe go through this one and then go and take a break, I would guess. All right, so first of all, fundamental analysis. Gold is relatively undervalued to financial assets. We're still midway through the cycle. 17 is still relatively cheap gold and relatively expensive stocks at the moment. Second, there is significant demand by smart money. Well, who's smart money? Smart money will be hedge funds managers. And there'll be some of the richer people in the world like Warren Buffett and all those, Bill Gates and whatnot, who do keep good chunks of their money. Well, Warren Buffett was a big buyer actually of silver, a lot more silver than gold. That's a different topic. But these people do buy significant amount in gold. And then there's big money. Big money is different from smart money. Big money are the funds, big pension funds, like California pension. Well, they're not yet invested much. Big money's endowments of Harvard, they're not. We're talking about billions of dollars. Big money will be sovereign wealth funds. If it's from the Middle East, they understand it a little better and they invest a little bit more. So fundamental analysis, okay. It's an inflation hedge. In times of inflation, overall, general prices, of all assets, the best performer is always silver. The second best performer is always gold. Again, but try put in $1 million in silver, see how does it work. Means, how do you get 1 million kroner of silver? How do you get it home?
You need to hire a truck.
You need a truck. That's why gold is. In other words, you can use small money to buy. 500 euros last time I got me a kilogram of silver. Okay, so I want to put in 50,000 euro. You're gonna make 100 kilograms. I can't even lift it off the ground. Okay, so silver is not as it's very good for small money, for little money, but for bigger money, there's no choice, there's no option. It is gold. Next one, it's inflation hedge. Well, central banks printing money, quantitative easing, you're all familiar. Quantitative easing 1 and 2 and 3. Central banks have increased money supply 2-3 times, depending on where you start. I will have a chart. Gold is by far, most certainly, the best currency hedge. Each government, the Chinese depreciates their own money so that they have competitive exports. The Koreans depreciate their own Korean won so they have competitive exports. The Japanese depreciate their yen so they have their competitive exports. Americans in turn depreciate, and that's been a policy of the American government to depreciate the dollar so they have their exports. Europe and Mario Draghi has been consistently depreciating the euro. So in all of these, which we call currency wars, the only one standing is gold. Even Switzerland was forced for a while, for many years, to peg the Swiss franc to the euro and to keep it depreciating step by step with the euro until they realize that pegging to the euro is kind of like the top kid in the school, hanging out all the time with the drunkards, with the Italians, and basically pegged to the euro was had a relatively disastrous effect for the Swiss economy. Okay, well, it's a crisis hedge. Yes, 2008, 2009, as long as the global financial crisis was raging, stock markets were crashing, gold was going up. Especially during the Greek, we call it the European sovereign crisis, okay? Greece, Italy, Spain, 2011, 12, gold was going up and up. Stock markets were crashing big time. And real estate wasn't doing very well either. So, in bad times, it helps you against crisis. It's an alternative asset. Stocks, bonds, property. Again, I've been explaining already significant part. There are times when one is a good investment, there's times when it's a better asset, and in uncertain times you stay somewhat balanced. You keep half in each, and you're in good shape. Central bank suppression. There's been a lot of literature, it's very controversial, that central banks, especially the US Central Bank, the Federal Reserve, additionally Bank of England, some other central banks have kept for a long time the gold price suppressed, which means you and me can buy it cheaper. Okay, when the suppression is eventually over, because they eventually run out of gold to sell, then the price will go a whole lot higher. So it's actually great. If they sell it to you cheaper, you buy it cheaper, no big deal. Central banks and gold sales. Okay, up until 2010, 11, even 12, a lot of central banks, the US Federal Reserve was selling a lot of gold. London, the British, sold a lot of gold, okay? Italians and all European central banks were selling gold. And at the same time, Asians were buying gold. Well, for the previous 10 years, they sold all that they could. And they have no more to sell. They ran out of gold to sell that they were willing to sell. So right now, only central banks are buyers, and we discussed, if you remember yesterday, who the biggest buyer was for 2017.
Putin.
Vladimir Putin. Russia was the biggest buyer in the world, and the second biggest buyer was Central Bank of China. But the others are buying too. Question here or not? Yes.
Yeah. You talked about the Western central banks. They were suppressing the price of gold, and maybe, if you look at the internet, also there's a lot of talks about also suppression of the price of silver.
Yes,
my question is, why do these central banks want to
suppress gold and silver?
Yeah, to summarize the question, so the question is, why are the Western central banks suppressing the price of gold as well as silver? According to sources on the internet and
right. Well, why would they do that? What's their motivation? It's very easy. When gold goes up, it's an indicator there is something wrong with the economy. Gold price going up either tells you that maybe there's a banking crisis going on, maybe there's a currency crisis going on. In other words, the gold never goes up for a good reason. It usually goes up for a bad reason. Gold is the market barometer telling you somewhere something is wrong, something's not working well. Well, it is a thermometer. You see gold going up, you know something's wrong. Well, what the central banks can do, say, well, they just break the thermometer. It doesn't show you that something. In other words, gold has a signaling mechanism, and central banks don't want gold to signal. Gold is actually a very good indicator that the economy is going down, just getting into a recession or a depression, okay? So they just don't want the gold to reveal something going bad. All right, gold sales, central bank buying gold. Okay, yes, a whole bunch of them. Qatar had been for a while a good buyer. Let's see, should be very soon. Okay, well, there's a whole bunch of investment demand, which is pretty much the same thing. If the dollar falls, the best hedge certainly against the falling dollar is gold. Not the euro, not the Swiss franc, not the Chinese, not the Japanese. Gold. Nothing protects you against falling dollar except gold. General currency market law. Yes, in the last 10 years, all currencies, especially as I was explaining, due to the currency wars, all currencies have become a lot more volatile. They go a whole lot higher and a whole lot lower. All governments try to manipulate their currency for their own benefit. It's called the beggar thy neighbor policy, where you depreciate your currency to gain trading advantage against the others. But it doesn't work. It works as long as they don't do anything. But of course, as soon as you depreciate your currency, they come back 3-6 months later and they depreciate theirs. It's only a race to the bottom. And the only way out for you, for me, is gold. Well, of course, real estate will also protect you against, but that's separate. So again, it is an outstanding protection against general market instability. And many of you should have, and will of course remember just what happened last month, February 4, 5, 6, okay, February 5 was the big crash. And again, gold performed the way it was supposed to. When all global markets crashed, gold was moving up in solid ways. Well, yesterday, we had a nice, juicy market crash. Stock market, Dow Jones was 700 points down, but the Nikkei was a whole lot worse. And pretty much all of Asia crashed, some more, some less, and today exactly the same, and exactly the same story. Yesterday gold was up quite a lot, $20, and today again, up until before I came, we started 10 minutes or 1 hour ago, it's been roughly again about $20. So gold is a great protection in these times. Of course, you got bank bankruptcies. When banks start falling, there's nothing else to save you except basically gold on the side somewhere else. Same applies for political fears, for wars, for geopolitical risks. I already mentioned economic fears. In other words, as market participants get to feel and sense that the economy is getting weaker and weaker, they anticipate, they expect the central bank will begin expansionary policy, the central bank will lower interest rates, and they expect the currency, due to the lower interest rate and to the money expansion, to depreciate, and they buy gold in anticipation. Okay, so gold is actually a very early barometer of something somewhere going wrong, whether it's bankruptcies or instabilities or volatilities or political or warfare, or any of these are usually bad times in one way or another. So gold is not meant to be an investment to make money. Gold is more of an investment to protect what you already have. You don't need again to put, and that's going to be actually the next section after the break, okay? This is the portfolio part. Okay, so welcome to Schuster Funds. Let me see if I have anything else. Okay, well, again, very easy to see picture, very easy to explain. Some buying of gold, as soon as it got to the global financial crisis, 2008 and 9, suddenly gold buying spikes, more than doubles. And then this is the European financial crisis. That would be Greece and Italy and Spain and all those going half bankrupt. And then you see it triggers even more buying. You can actually see from 300-400, buying goes down to 1,700. So gold buying can increase easily 3-4 times. Significant amount of buying, which of course drives the price of gold significantly higher too. Fundamentally, you got consumer demand, you got a lot of rising jewelry, that's big. In China, jewelry is big. way bigger is in Dubai and the Arab world. We're just talking 95% of all gold buying in the Middle East is in the form of jewelry. Just the same in India, okay, so they buy the jewelry instead of the coin or the bar or the bullion itself as a substitute for it, and they might as well wear it while they have it, right? And of course there's some industrial demand, that's very clear. There's been always an industrial demand. And again, now gold investors are already, the small people and funds are bigger than the central banks. In other words, central banks have already lost most of their gold, it's already sold. So sooner or later, central banks will be turning from sellers, they've been sellers for the last 20 or 30 years, into eventually buyers, okay? And right now, only 1 or 2% of all liquid assets are in gold. This is a tiny amount. Usually, when things go bad, gold would be 10 to 15% represent of all liquid assets. So from here on, liquid assets relative to gold, gold has the potential based on this indicator to go just roughly about 10 times, which is similar to stocks. Now, if you make the ratio to real estate, I'm just throwing it in, the ratio is just about 5 to 1. In other words, gold's got up. Now, stocks are actually even more overvalued than real estate. That's another topic for another day. Yeah. Probably the last one. You see here what's been happening. Central banks, the total cumulative money which they have, the money supply. You can see the PBOC, that's China, the Fed and the DOJ, the Swiss National Bank, Bank of England, and all major banks. They were roughly about 3.5 trillion. That's the money supply. By or before the global financial crisis, they were up to 6 or 7. They had roughly doubled the money supply. That's a massive inflation. Double the money supply. That's never seen before in human history. And then when the September 15, the crisis hits with Lehman Brothers going bankrupt on that day, suddenly they print in 2 months, you can see the increased money supply, roughly 30% in 3 months. And then they just keep printing. And you see here, since then, from 8 or 9, they're up to 17, and that's only 2016. By now, 2018, it's over 20. So in the last 10 years, they've doubled the money supply again. This is massive inflation, which shows up. It shows up first and foremost in housing, shows up second and foremost in stocks, shows up worst in cryptocurrencies, and then everything else. I mean, everything else is expensive. And, okay, so in fundamental analysis, you can just see stocks are currently overvalued. Bond prices have been highest in human history, okay? I mean, we've never seen so low interest rates and so high bond prices. So, stocks are relatively highly overvalued. Bonds are relatively overvalued. Real estate is relatively overvalued. Currencies, only due to currency war, where each government wants to depreciate their currency, currencies are relatively overvalued and will be further depreciated in the near term. Now we can go from currency wars to the new thing from last week or month is trade wars. Starts with Trump imposing tariffs on China. And yesterday China comes back and says, we're not going to take it. We'll retaliate and impose back the end. We're back to trade wars. And finally, you got relatively undervalued commodities. So it's not only gold. I mean, it's platinum is also cheap, okay? Platinum is cheaper than gold. Silver is relatively undervalued to gold. So, in a sense, silver is much better buy these days. And platinum, again, but it's the VAT tax and whatnot, and you gotta get the coin. It's a little, platinum and palladium are a little trickier. Again, that's why you stick with gold, that's a little simpler and easier. And
I think well, let's take a short break. Vi ses igen om 5 minutter. Der er stadig mulighed for forfriskninger derude, og I kan stille alle de spørgsmål, hvis I vil. You're more than welcome to ask Professor Hedge some questions.
yes, of course.